How's that? It's Brendan here from Infinity Investments, and even though we're on holiday here, deals don't stop. You can never sleep, and that's the thing about entrepreneurial life, I suppose, is it never actually stops. You can slow it down for a little bit at certain times of the year, but then when deals land on your desk and we get the LOI signed, now it's time to get the engine started and get going again. So I've stolen an hour out of the holiday here to sit and build a spreadsheet on a deal that we're doing. So it's 64 units and 3 retail little pieces at the bottom of the building. And what I'm trying to find here is the truth. So we've got a letter of intent signed. We're now moving to the purchase and sale agreement. They send some figures through, and obviously there's one lesson you'll learn doing deals like this is the offering memorandums always lie. So what they sent through here in terms of the trailing 12 months of income and expenses is I can see there's a little bit of a disparity already that's starting to make me a bit nervous. Is the operating expense ratio is a little bit too low for the US market. So typically we're looking at around 40 to 45, sometimes even close to 50% as an operating expense ratio, depending on the number of staff, the size of the property, how much groundwork there is, how much maintenance there is, that type of stuff. And on this one, it's kind of coming in at like 27, 28%. So that's making me a little bit nervous. I want to make sure. So now I'm going to start making some notes on our due diligence sheet on the type of stuff that we want to just verify. The other thing they didn't send through was the lease agreements for the new tenants that are moving into the 3 retail centers at the bottom. So I just want to verify those numbers. But if we build out the spreadsheet over here, what's amazing is the positive cash flow. So if we can get our debt at 5% or below with an interest-only period for, let's say, 2 years, I think we could possibly get 5 years on this one. So if we can get interest-only for 5 years, it'll be phenomenal. But even on 2 years interest-only, we're looking at 10.5 to 11% positive cash flow on our deposit straight out the gate. So if we're buying this at 10.5 million, this is probably a video we should name how to underwrite a $10 million deal in 10 minutes or less. So obviously it doesn't take 10 minutes. I'm being a bit facetious here, but you can definitely get a gut feel on the go no go on whether you should pursue a deal or not pursue a deal very quickly. And it's the back of the matchbox calculation, or we call it the go no go. And it should give you an indication on whether to pursue the deal further and actually do a deep dive due diligence, or whether to just kind of drop it. On this one, we're buying it at 10.5 million roughly, with closing costs and fees and all the rest of that stuff. It's a going in cap rate of about 7%, which is pretty good in the Atlanta, Georgia market. That's where we're buying this. Exit cap rate, we pro forma at 6.5%, and deposit requirement of $2.8 million. So that would be, I think it's about 75% loan to value. Well, it's working out to loan to cost is about 75%, but loan to value about 79%. So $2.8 million over a 30-year amortization with a 5% interest rate. We're coming in here at 10.5% positive cash on cash returns. So if we're going to put in 2.8 million and get roughly $300,000 a year in positive income, that's pretty cool. I'll do those deals all day long, every day. Cash flow investing, that's the stuff. That's what sets you up for financial freedom. It's not the hope and pray strategy. This is the deploy money, get income immediately in the first quarter, hopefully even the first month directly after we take transfer. That's what sets you up for financial freedom. Then it's a case of what can we bump the rents to? So are they trailing market rents? And in this particular case, there are trailing market rents, and the building is absolutely beautiful. It's a historic building that's been renovated to a very high standard, and we are definitely one of the best buildings in town. And on that basis, on the existing buildings that are in town, the cost for them to convert and to compete with us would be quite high. So I like that. In terms of our cost per square foot, we're coming in reasonably strong. For somebody to duplicate what we've got over there would cost them a hell of a lot of money. And from that perspective, we want to understand the market a little bit more. Where are the employers coming from? I know Geico's there. I know there's a huge Air Force base there. So there are a lot of employers in that area. So we know that we will continue to get the type of rental returns that are already being received by this particular property going forward. So I'm liking this one quite a lot. Just on the gut feel, go no go. What is worrying me is that expense ratio. Obviously, if the expense ratio is out of whack in reality, so we're going to go look at the actual financials for this building over the last 2-3 years, try and evaluate exactly what it is going to cost to run this building. I think it might be slightly out of whack because it's a single pad site with very little gardens. So there's no landscaping or garden maintenance or anything required on this particular building. And I think that might be why it's a little bit out of whack. We also don't have to employ too many people because it's only 64 units. So there won't be as high of a staff complement required to run this building. And we don't need a landscaper or something like that permanently on site. So from that perspective, that might be the reason why these expenses are quite low. We're going to validate that to check for ourselves so that we don't end up in a situation where somebody's told us that the expenses are low and they're actually not as low as we thought they would be. They're much higher, and then obviously our cash flow will take a bit of a hit. So that's going to be the main thing I want to understand over here, and then I want to understand the market drivers. Are we trading market rents? Can we push the rents up a little bit? If we can push the rents up $100, $200 a month over the next 12 to 18 months, that'll give us some forced appreciation and a nice capital bump. So if you underwrite deal like really quickly, if we're taking 64 units and we can get $200 a month, if we go 64 times 200, 64 times 200, because remember, our expenses don't change if we can push the rental income up. Our expenses should remain more or less the same. So that's $12,800 a month times 12. It's $150,000 a year, and if we cap that at the same 6.5% exit cap, we're talking $2.3 million in capital upside over here. So I like that. If I can lay out 2.7, 2.8 million and make 2.3 million in capital upside, if I can bump the rents $200 a month, that's the kind of deal I want to do all day long. So in 12 months, create $2.3 million. That's almost 100% return in 12 to 18 months. I like that kind of deal. So let's see what we can do. I look forward to following up with you on this one. If you are keen to invest in properties like this, let me know. We're looking at deals all the time. I've got another one in Atlanta now. It's $6 million that we're looking at. It's about 86 units. So we're getting them all the time. I obviously can't buy everything in America, so we are looking for partners. But if this type of stuff excites you, if cash flow investing excites you, if passive income excites you, that you can sit here, like I'm sitting here in Mauritius underwriting a cool deal, and the only reason I'm able to do this is because of the property portfolio that we got over there. And the only reason I've got the property portfolio is because I helped other people buy the same properties that I like buying. So if you are keen, let me know. Send me a private message, email me, phone me. My email is brendan@infinityinvestment.com. And I look forward to catching up with you. Thanks. Bye.